Hello everyone, and welcome to today's webinar where we will focus in on the topic, what does it take to set up and operate a foreign company in China? This topic, as I'm sure most of you are very aware of, is very relevant for European small and medium-sized enterprises who are considering or wondering, contemplating how they can get into the Chinese market. We keep hearing all these numbers about the Chinese growth numbers, and the figures estimate that in 2021, the Chinese market will be the only major economy that goes back to the, so to speak, normal GDP growth. So today's topic is one that us here in the EU SME Center in China, together with the Danish Chamber of Commerce in China, have arranged today's workshop on. So while we're waiting for the last ones to join us here online, I just want to say thank you for taking the time to check us out and hear today's topic. To guide us and tell us how we can understand this, what does it take to set up and operate a foreign company in China, we have invited the speaker, Mr. David Norm Stern, who is the co-founder and China business advisor at China Direct Biz, who are operating here in Shanghai in China. So before we get to Norm's presentation, I just want to map out a little bit how today's webinar is going to work. We're starting now, and I'll elaborate a bit on the EU SME Center, also a little bit about the Danish Chamber of Commerce. And once we get past that, then we will go on with Norm's presentation, which will last roughly around 40 minutes or so. And then at the end of today's webinar, there will be an open floor for a Q&A session that we highly encourage you to submit questions to if you so may wish to do. And now, if you, at the end of today's webinar or during the webinar, feel like you wish to submit a question to the Q&A session, then please do so by clicking the Q&A button down below and submit your question, which we will then get to answer anonymously at the end of the webinar. Today's webinar is, of course, free for everyone to attend, and we're very happy to provide this service. What we hope for is that we can get some of your feedback back after the webinar, so that you may take 1 minute or 2 minutes to let us know how we can improve this platform and this service to you, the EU SMEs, in the future. If you, after the webinar, would wish to help us to fill out this survey, then please scan the QR code that is on the screen now. That QR code will come back to the screen at the end of the webinar during the Q&A session. Now, before we get into the topic, I just want to explain a little bit about who the SME Center is, what the EU SME Center is doing in China. And basically, the EU SME Center is a EU-funded project from 2010 with the main purpose to help European small and medium-sized enterprises, SMEs, to get ready to do business and grow in China. You can read more about the EU SME Center progress since 2010 and up until 2021 on our website, which is the eusmecenter.org.cn. Currently here in 2021, we are running in our third phase of the EU SME Center, which is running from October last year up until and including March of 2022, so an 18-month session. The way it works is that the EU SME Center has 5 different implementing partners, which consist of European chambers of commerce or business organizations here in China. The EU SME Center here in China is also an official member of the European Enterprise Network and has up until this day partnered with over 270 government agencies and business support organizations in Europe and in China. Our services are very much both online and offline, but our physical office is located here, boots on the ground in Beijing, where I'm sitting now, in the Sanlitun area, so right in one of the business districts of Beijing. Now, to elaborate a little bit more about the different kinds of services which the EU SME Center provides as part of the project, is basically we can divide it up into 4 different parts. The first one we call the Knowledge Center, and that is that up until now we have nearly 200 quite comprehensive market reports, guidelines, and case studies on approaches and learnings from the Chinese market. All of these reports are also available on the EU SME website for free for EU SMEs to read. The second aspect is that we also operate as an advice center with practical and confidential advice on business development, market access, legal issues, and HR, which is of course very related to today's webinar topic, how to get started as a foreign business in China. The third of the 4 aspects is also very much related to what we're doing here online today, is that we also function as a training center where we provide face-to-face and online training programs that raise the EU SMEs' awareness of China-related business issues, such as today's topic on how to start up business in China. The last part I just want to say here about the EU SME Center here is that the SME advocacy platform is also what we consider the EU SME Center to be. And that is by providing coherent, consistent, and consolidated voice for the EU SMEs via the Interchamber SME working group that's provided by the European Chamber of Commerce as well. So that is a bit about the EU SME Center, our overall services that we provide. So basically, it covers a lot of different grounds. If you have any questions that you would wish to ask to the EU SME Center that may not relate to today's webinar topic, then you're always invited and encouraged to visit the EU SME website, where we have an Ask the Expert function, where your questions will be directed to people in the know, who will then get back to you with the best answer possible to your question. And that is whether or not it's questions about the Chinese market, technical assistance, or other things, perhaps finding Chinese partners here in China. All of these things and more is something that you can go to the EU SME website and use the Ask the Expert function to submit these questions. That is completely free. So today's webinar is of course on doing business in China, but we also have a lot of upcoming events, and I'm not going to go through the whole slate here, but just want to show them here so you can see what topics we will also be covering in the weeks to come, in the end of March and in the first half of April. Some of them are offline here in China, but most of them, if not all of them that we have here on the slide today, are also available online as well. So please look up the EU SME website, the WeChat platform, which we use here in China, or Twitter or LinkedIn to find more information as to how to register for some of these events. All the events on the EU SME are completely free of charge and are seen as a service to assist European SMEs doing business in China. Besides the event, I also just want to say that there is monthly working group meetings and policy briefs. The EU SME participates, helps with participation in trade fairs and exhibitions here in mainland China. EU SME Center also has 11 new reports to be produced and published, including articles and case studies. And then there's also a frequently asked questions database plus a self-diagnosis tool for assessing readiness to China, which we plan to launch by the end of this month of March. Now, that is all that I will start out by saying about the EU SME. But the EU SME is not run entirely by its own. It has the help of 5 implementing partners. And one of these implementing partners is the Danish Chamber of Commerce. And today's webinar is created in collaboration with the Danish Chamber of Commerce. And who am I? My name is Nikolaj Lundsbjerg, and I am the General Manager of the Danish Chamber of Commerce. So I just want to take a few more minutes to let you know what the Danish Chamber of Commerce is for a type of organization and what we're doing here in China. Basically, we were established by the Ministry of Civil Affairs officially here in China in 2000. So we're running on our 21st year now. We have 3 different offices or chapters, as we call them, in China. We have North China, covering Beijing and the region around it, East China, covering Shanghai and the region around it, and then we also have South China, covering Guangzhou, Shenzhen, and that region down there. Our membership comprised of over 170 Danish corporate member companies, covering more or less any sector that you can think of. So for this phase 3 of the EU Sme Center, the Danish Chamber of Commerce became an implementing partner of the EU Sme project for these 18 months, started October last year and running until and including March of 2022. Danish Chamber of Commerce, we strive to be the main platform for Danish business community in China, to keep it brief. Now, we are one of 5 implementing partners in the Danish Chamber, but the other 4 implementing partners are respectively the China-Italy Chamber of Commerce, the China-Britain Business Council, Euro Chambers, and the European Union Chamber of Commerce in China. So that are the 5 different implementing partners. Also, slate of activities that we have on the program from the DCCC side. I'm not gonna go into them and bore you with them right now. Just want to highlight that we're trying to stay active and cover as much ground that could be relevant for a lot of Danish SMEs, but also, of course, other European SMEs, both through the EU Sme project, but also through other projects. Now, with all of that out of the way, finally, you can find more information on the Danish Chamber either on LinkedIn, our website, or WeChat. And I think that will be the final word that I will have before introducing today's speaker. So to go back to today's topic, which is on how to set up a foreign business in China, we have invited the speaker, Mr. Noam David Stern, who is the co-founder and the China business advisor at China Direct Biz, operating in Shanghai. Noam has much experience through many years assisting companies and EU SMEs setting up operations in China. So we're very happy to have Noam sharing his advice with us today. Noam will have around 40 minutes, give or take, and then there will be the Q&A session at the end. And I just one more time want to tell to the people who just registered that there will be a Q&A session at the end, where you can use the Q&A function here in Zoom to submit a question, which we will then get to by the end of that part. Now, with all of that out of the way, I will stop sharing my screen here, and then Noam, you are very welcome to share your slides and take the floor. Thank you.
Yep, thank you, Nikolaj. And hold on. Okay, thank you, Nikolaj, and good morning and good afternoon to you all from Shanghai. My name is Noam David Stern, and I'm from Copenhagen, Denmark, but have lived and worked in China since 2005, where I continue to support foreign companies doing business in China. Today, I'm the co-founder of China Direct Biz in Shanghai that offers practical advice and supporting services to foreign investors and mostly Scandinavian companies with their market access, company establishments, and operations in China. But behind me, I also have an experienced team of Chinese legal and financial professionals. And during my time in China, I've probably been involved in so far the setup of 70 foreign invested companies in China. My presentation will follow this outlined agenda, and as Nikolaj said, will take about 40 minutes, followed by a Q&A. So there are a lot of topics to cover, so I'll just get started. Until a few years ago, setting up or operating a foreign invested company in China was a difficult, slow, and costly process, which has created this wrong perception among many foreign investors, and not least SMEs, that it's too risky and not worth the trouble. But over the last 2 years, China has actually introduced a number of new reforms that have made it steadily easier, quicker, and cheaper to both set up and operate a company in China. An example of that was in March 2018, where China introduced the one window, one form policy with the aim to simplify and streamline the company registration process by creating a national digital platform to be implemented nationwide. And to further the reform process and also to somewhat rebuild confidence among foreign investors, China also approved the new foreign investment law that took effect on the 1st of January 2020. And with the new foreign investment law, the previous foreign investment laws like the equity joint venture law, the corporate joint venture law, and the wholly foreign owned enterprise law have now been replaced by one single unified law, which is the foreign investment law. And according to this new foreign investment law, it is now the company law and the partnership enterprise law that regulate the organization form, structure, and operating rules of not only domestic companies, but also foreign companies in China. So the term WFOE or wholly foreign owned enterprise is actually not any longer applicable, and I will now refer that to a China company limited or China entity in the presentation. These reforms are also very obvious if you look on a number of international indices. And here I've just taken the latest ease of doing business index from the World Bank. And here it's quite clear that China over the last couple of years has really moved up in the ranking out of 190 economies. And especially if we compare with some of the neighboring countries, China is actually quite far ahead and open for business. With the trade war with the United States and COVID-19 pandemic, one would then perhaps also assume that China would be less interesting for foreign direct investment. But if we look at the official numbers, it's quite evident that China continues to pull in foreign direct investment in large numbers. So if we look at the 2019 statistics, China was behind the United States. But if we look at the latest numbers that I've been able to get, China actually overtook the United States as the world's largest recipient of foreign direct investment in 2020. This is perhaps also reflected in the real GDP numbers, as also was mentioned by Nikolai in his introduction. Again, if we just look at the 2019 numbers, China was, despite the COVID-19 pandemic, one of the only major economies, if not only, the only one that experienced growth in 2020. 2.3%, the lowest in decades. But again, if we relate that to, for instance, the EU 27, again, China has actually been able to continue its growth. So if we look ahead in this year and the next year, you could say that while China's economy continues to expand, most other major economies will actually only recover what has been lost during the pandemic over the next couple of years. That then leads me to really the main topic of what does it take to set up and operate a foreign company in China. And as I mentioned in the introduction, the foreign investment law has actually replaced the previous investment laws. So today I will refer it to as a China company limited, and in simple terms, a China entity can then be involved in services or consultancy, trading, and or manufacturing. And it's really, you could say, the purpose of the China entity that will regulate the type of business activities that your China entity can conduct. And this will also determine the company setup process and registrations. So as the name indicates, a China entity is a limited liability company, and then it would also enjoy equal national treatment to domestic companies, will have the same rights and obligations, but there are some certain restrictions that do apply according to the negative list that I will cover in a moment. So really depending on the approved business scope that is stated in your Articles of Association and on the business license, and here we're talking about the China entity, then you will be allowed to conduct or carry out different direct business activities, such as hiring people directly and also issue legal invoices. For some industries, products, or business activities, additional licenses and permits are required. So for instance, food production or medical equipment and similar. So this leads me to the negative list. And the idea or concept of the negative list was first introduced with the launch of the China Shanghai Free Trade Zone back in September 2013, and then has since been adopted nationwide and then also written into the foreign investment law. In simple terms, the negative list basically refers to industry areas or business activities that are either restricted or prohibited for foreign investors. But if your activity is not on the negative list, then you no longer need to apply for pre-approval, and you will basically be treated under the principle of consistency or equality with domestic companies. And this also applies to the various national support policies that the Chinese government or local governments are implemented. So in general, China operates with, you could say, two categories of negative list. We have the negative list for foreign investment only, where you have a negative list that applies to all of China. And then you also have a negative list that is aimed at the many free trade zones or special economic zones. And with the launch of the Hainan Free Trade Zone, the number of items on their negative list is actually only 27. And then you also have a negative list that applies to both foreign and domestic investment in China. In addition to a negative list, there is also what I refer to a positive list, but more precisely, it's called the catalog of industries of encouraged foreign investment, which really specifies the industry sectors and activities where foreign investment is encouraged. And the latest catalog took effect this year on the 27th of January. And it basically consists of two chapters, one for China alone, and then one for the different provinces in the central, western, and northeastern regions. And if you study the encouraged list or the catalog, you will see that the priorities are definitely given to advanced manufacturing, production-oriented service industries, and any activities that can somehow spur growth in China's central, western, and northeastern regions, which is also often referred to China's Go West policies. And if you are on the encouraged list and you comply with the requirements, then you as a foreign investor can then enjoy some preferential treatment, either from the central government or in most instances from the local governments, such as a lower corporate income tax. And when it comes to corporate income tax, the standard CIT is 25%, which is actually relatively high compared to most countries and economies in the region. But China is fully aware of this and offers a number of tax incentives. So if your company is investing in one of these encouraged industries in the western regions of China, if you are involved in certain environmental protection industries, if you qualify as a new high-tech enterprise, then you can actually enjoy a corporate income tax of 15%. And for certain industry projects, you might also be offered tax holidays, typically 0% tax on the first 2 years' profits, and then a 50% discount on the following 3 years. When it comes to the environmental industry, the current incentives are to expire this year, but they have now been, it's not been decided that these will be extended further. And then I'll also highlight a tax incentive that is aimed at smaller private companies, which is obviously quite relevant for a lot of SMEs. And this is a tax policy that is also supposed to expire by the end of this year. But again, the Chinese authorities have also decided to extend this special incentive. So basically, if you have an annual taxable profit of less than $1 million, then you will actually only pay an effective tax of 5%. And if your taxable profit is between 1 and 3 million, then again, you pay the 5% on the first million, and then you pay 10% on the 1 to 3 million. And then you will basically get an effective rate of up to 8.33% if you hit the maximum. So this is actually one of those incentives that China have adopted to really attract SMEs to China. That then leads me to a very important topic called registered capital. And this is in many ways still a misunderstood area that continues to create some uncertainty among foreign investors. So in simple terms, the whole purpose of the registered capital is to ensure that your China entity has access to sufficient capital to support its daily operations. So basically, you have the cash flow to sustain yourself financially. And the registered capital should then be set according to the actual capital needs of the China entity to ensure solvency. This is actually quite important. And until the end of February 2014, it was quite common that you would hear the term minimum registered capital. And this was really in the days where a lot of local governments were rewarded based on how much registered capital they could pull in. But from the 1st of March 2014, these minimum requirements were abolished unless they're stated on the negative list. And the previous 2-year payment period was also abolished. So now you can actually inject this capital during the lifespan of the China entity, which in China is up to 30 years. Getting the registered capital right is quite important. Obviously, many companies, and especially SMEs, don't necessarily make a profit the first 1, 2, or 3 years. So having access to finance or capital is, of course, essential. But you need to, of course, also be aware that if you use up your registered capital quota, and you're not able to sustain your business with the required cash flow, then it's not a matter of just sending some more money from the mother company to the China entity, because this would basically be taxed as company income. So in order to basically increase your access to registered capital, you need to raise the limit. And this is a process that typically takes 8 to 12 weeks. So it's really important that you keep an eye on the registered capital so you don't end up in a situation where your company is basically underfinanced. In this situation, you also need to be aware of this table that the Chinese authorities are also still using. So there are actually some restrictions on how much a company or China entity can borrow either in China or overseas. So for instance, if your registered capital is $1 million, then that will basically equal a total investment of $1.428 million. And the difference between those two is basically the maximum capital loan ratio, which in this case would be $428,000. So in simple terms, the bigger your registered capital, the more you are also entitled to borrow. That then leads me to another quite important area, which is tax registration and VAT. So basically, in order to conduct transactions and issue official tax invoices in China, you need to register your company with the local tax bureau in the same district as where your official address is. And I'm here to talk about the Chinese company's official address. And here China basically categorizes VAT taxpayers in two groups. You have a small-scale VAT taxpayer if your annual revenue is below or equal to 5 million, or a general VAT taxpayer if it's above 5 million. But from the beginning, the new entity can choose to either become a small scale or a general VAT taxpayer. But if you register as a small scale VAT taxpayer, you can later change to a general VAT taxpayer, but not the other way around. And in terms of the VAT rates, it's basically 6% on services and then 9% and 13% on goods. This basically also leads me to the official invoices, because you need to basically register with the tax bureau in order to issue these invoices. And these are basically legal receipts on a purchase, and are also used to track payments in China. Most of you are probably aware that you have this special printer and you get these invoices on paper. But increasingly, China is also introducing digital QR codes where this is handled automatically or electronically online. When it comes to the different types of VAT taxpayers, you need to be aware that as a small-scale VAT taxpayer, you only pay a flat 3% VAT, but you are not allowed to basically offset your input VAT against your output VAT. And you're only, in this case, able to issue general VAT invoices as proof of payment. But because of COVID-19, the Chinese government, I think in April last year, basically decided to reduce this 3% to only 1% until the end of 2020. But again, the Chinese authorities have actually announced that this will also be extended. And then there's also a general rule that basically says that if your sales are less than 100,000 per month or 300,000 per quarter, then you don't actually have to pay any VAT. And as I have recently also read, the Chinese authorities are planning to raise this limit to 150,000 and 450,000 respectively. If you are a general VAT taxpayer, on the other hand, then you will actually have to pay the 13% VAT on goods and 6% VAT on services. But in this case, you can then offset your input VAT against your output VAT. And in order to do this, you need to have issued special VAT invoices. That leads me to accounting, financial reporting, and tax filing. And in some countries, this is something that companies can either do themselves online, and it's actually relatively simple. But in China, there are still some formalities in place, some requirements that need to be fulfilled. And these requirements actually start from the moment your business license has been issued and the tax registration is completed. So even if you run a turnover of 0 the first couple of months, you are still required to comply with these requirements. No point in going into detail. This is something that any Chinese accountant or finance manager will be aware of, and you can also outsource this to professional service and accounting companies. That then leads me to profit repatriation, and there are, again, many negative stories that you will hear about foreign investors not being able to get their profits out of China. But I would say in most cases, this is often due to lack of proper understanding and compliance with the existing regulations and procedures. So if you fulfill the requirements, there are no restrictions on repatriating your profits or dividends. But there are obviously some requirements that need to be fulfilled. First of all, you can only repatriate profits after the registered capital has been paid. So you need to again be aware that when you set the registered capital, that there is this requirement the moment you make a profit and you wish to repatriate them to your home country. Furthermore, you can only distribute dividends out of accumulated profits in which previous year's losses can be carried forward for up to 5 years. So again, you need to be aware of this if you make a loss the first couple of years and then suddenly make a profit the following years. And furthermore, profits can only be distributed and repatriated after you have filed an annual audit report and a so-called CIT reconciliation report. And furthermore, you paid the 25% corporate income tax or 15%. And then also when it comes to the actual transfer out of China, you also need to pay a withholding tax of 10 or 5%. But before the bank can then transfer the money overseas, you will then also need to provide this annual audit report and a tax payment slip confirming that the required taxes have been paid. But again, this is something that applies to all companies in China. And then finally, you also need to be aware of what is called a general reserve fund. So before dividends can actually be paid out, and that both in China or overseas, 10% of your net profits must be allocated to this reserve fund. And once the accumulated amount reaches 50% of the registered capital, then you no longer need to contribute to this reserve fund. But it's important to say that we talk about accumulation of funds that can be used freely for operational expenses. So in the table, I just tried to kind of illustrate what the kind of tax implications are if you want to repatriate profits or dividends overseas. When it comes to the withholding tax, and I wrote on the previous slide, 5 or 10%. In fact, the law actually says 20%, but the tax authorities have for years actually adopted 10%. So in the end, you actually need to refer to the double taxation avoidance agreement signed by China and your home country. And there are today more than 100 of these DTAAs. And in order to enjoy these preferential tax benefits, you actually need to apply yourself. So the Chinese tax authorities will not remind you or mention that China and your home country might have signed an agreement that will lower that tax. So for instance, I know for Denmark, the withholding tax is only 5% if the investor has minimum 25% share in the China entity. But you need also to be aware that the Chinese tax authorities are pretty strict these days. So they are very much focused on the beneficial owner status. So in order to basically enjoy some of these tax or treaty benefits and a lower withholding tax, you actually need to document that you as the investor is a permanent establishment with a genuine business that generates income and have people employed. And if 50% or more of your dividend is simply transferred onwards to a third country, or the recipient is based in a low tax jurisdiction, then the tax authorities will also be less inclined to approve this beneficial owner status. So again, the key is you can set up a holding company, but important to understand that it actually has to be a real business in order to comply with the regulations. This leads to a very related topic, which is payment remittance. As I mentioned, the corporate income tax in China is relatively high. So there are some methods where you can reduce this burden. And a very common practice is actually for your China entity to sign a service agreement with the overseas parent company, but it needs to be for actual services delivered according to the arm's length principle. And the service fees that are then paid for those services by the China entity to the parent company are also subject to 6% VAT and some surcharges, which are typically around 1%. But if the services that you are providing are considered a permanent establishment, so it's basically delivered for 183 days or more within 12 months, then additional withholding corporate income tax may also apply. And this is basically based on what they call a deemed profit rate of 15 to 50%. And this is really determined at the sole discretion of the local tax bureau. Paying the VAT and these surcharges, and in some cases also the withholding corporate income tax, actually also applies to companies who are not based in China, but who are basically providing a service to a customer in China. And in practice, it's actually the service recipient in China that need to act as the withholding agent, deduct the taxes, and basically pay and file to the local tax authority. Again, this is something that is pretty standard for all companies, foreign companies in China. That leads me to the next really important step, which is the company registration process. I've focused a lot initially on the operational issues because it's really important from the beginning that you understand the requirements before you actually get going with the actual company registration process. So here I've made kind of a flow diagram with 11 points that I will very briefly go through in the next slides. The first is what I will call really the key to any successful company setup in China and operations for that matter. And that is really the planning and preparation phase because it really requires careful planning, preparation, and also basic understanding of what I call the most critical success factors before you make any key decisions and start the process. So really understanding what the requirements are and what you need to do in order to build your business in China is really key. Because if you don't get it right from the beginning, you end up with a company entity that might not be able to build the business that you are planning. And that will, of course, both take time and be an expense. But when all that is said and done, then the first step in any setup process is actually to get an official registered address. So you actually need to get a lease agreement. Without this, you can actually not start the registration process. And here the requirements are quite clear. You actually need to provide a signed lease agreement for a minimum 12-month term before the filing can be initiated. And the lease premises, whether it's an office or production facility, must be in what is called a registered commercial property with its own unique address, as more than one company cannot share the same official registered address. There are some government-sanctioned incubators in China where the agreement or the requirements are more flexible, but certain requirements do apply here as well. When the first two steps are done, then the next step is actually to prepare and file for the business license. And here there's a lot of information and documents that needs to be collected. And based on that information, then the drafting and review process will get going. And in China, there's both an initial online registration followed by an on-site registration. So the key is really to make sure that your expectations are aligned and you understand what you need to do in order to operate your business when the license has been issued. And here there are actually some initial steps like getting your company name in Chinese approved, including your business scope as well. And based on that, the Chinese authorities will then be able to issue a business license in 8 working days. But we have examples where it could actually be done in 5 working days. So it's really important that the moment you are ready to push the button, then it would actually go relatively quickly, and then you will have a company, a legal entity registered in China. But before your company can actually be operational, there are also a few steps that needs to be completed. And these are coming in a natural progression after the business license has been issued. First of all, you need to apply for some company seals. And in China, it is actually the company seals that can legally authenticate documents instead of a signature. So this is a completely different way of authenticating documents compared to Europe. So it's also very important that you don't give the responsibility of all the seals to one person, because then in effect, that person will have the power authority to basically do what he or she wants to do with your company. Then there is the application for a legal entity key, And if you are involved in manufacturing, then you actually also have to go through an independent environmental audit, where depending on the type of production, you will then be classified as either a small, moderate, or significant. But this is again a big chapter in itself, which I will not focus on in this presentation. And then you have the tax registration that was mentioned before, where you need to decide the type of status you want from day one. Then you have the opening of company bank accounts, where you will need a foreign capital account in USD or in Euro, and then a basic current account in RMB that will allow you to basically conduct business in the local currency. If you want to employ people, you also have to go through an employer registration. And if you want to do import and export, you also have to apply for a trading license. And for certain industries, there might be other licenses and permits that you need to apply for in order to operate your business in China. That said and done, of course, the focus of my presentation is how to set up and operate a company. But obviously, how to deregister and close a company in China is also something that is quite important before you actually start the process. And I would say that this is really depending on the company or your company or the type of business activities you are in. It can sometimes be a little bit of a complicated matter, especially if you set up your company and receive a lot of preferential incentives, where the local government might have an expectation that you should somehow give them something in return. So what I'm going to outline now is basically what I would call a best case scenario, and it's actually a simplified version of the process. So in order to close a company, the first you really need to be aware of is that you need to apply for a tax clearance certificate. And this, I guess, is something that is also valid for most other countries. So in order to get this tax clearance certificate from the local tax bureau, then you basically need to show that you have no outstanding tax payments, you paid all, if any, fines or penalties, you've handed in your special VAT invoices together with this printer, and then you also need to have a Class A or Class B tax credit rating. So China has this A, B, C, D, and M. When this is done and you have received the tax clearance certificate, then you are then able to apply for what they call this online simplified deregistration procedure. And before you actually file your application for closing your company, then you need to basically make sure that all your creditors' rights and debts have been settled before the process can begin. And once you post your closure of or your deregistration online, then the authorities and the public will have 45 days to make objections. And if no objections are made, then you have 30 days to submit a number of documents. And then after the filing of these documents, then the local state administration for market regulation would then make a decision within 3 working days. And if they have no comments, then in effect, your company has been closed. So easier said than done. There are a number of key steps that you need to go through, but increasingly this is actually becoming easier as well in China. That then leads to basically the final chapter of my presentation, and that is a practical advice. And this is, of course, based on my many years of experience in dealing with foreign invest companies in China. The first step relates to IPR protection. And here I can only emphasize and re-emphasize that if you're thinking about China, planning to go to China, or already in China, please make sure that you have registered your IP rights in China first. And this goes both for trademarks and also design patents and similar IP rights. And this is simply because China uses this first to file the system. So whoever registers first will get the exclusive rights. There are obviously ways around this, and you can actually file oppositions if others have tried to register your trademark in China. So I would say rule number one, no matter what your plans for China are, either now or in the future. Then I've also put go-to-market research. And here it's really important to say, although you hear all these fantastic growth numbers in China, it's quite important that you don't conduct your business based on what I call big empty promises, hearsay, and wishful thinking. You really need to understand the market, the Chinese market, that it actually is like its own ecosystem with its own rules of the game. So really important, make sure you do some market research, you examine the actual market conditions before you start with the company setup or engage with sales in the Chinese market. But I will also emphasize, don't overdo it. There are too many companies that spend too much time, maybe months, on making some market research. And when they are then ready to execute, most of those conditions are actually no longer valid, simply because the Chinese market is extremely dynamic and moves very rapidly. Then I've also put in background checks, and this is again, if you are planning to set up a company in China, or maybe initially you want to use distributors or agents on other partners, do make sure you do a background check before you commit to legally binding agreements. Unfortunately, there are really a whole industry of what I call professional scammers that will exploit blind faith and trust. So it is not a qualification itself that your potential partner speaks English or is a nice guy. Please do some background checks just to give you kind of the peace of mind before you commit. And then I will also really highlight contract reviewing and drafting. Again, there are too many examples where companies enter into agreement based on their own country's laws, rules, and regulations, and then they try to kind of adapt this to a Chinese setting, and often you end up with a piece of document that is not really enforceable in China, and then you basically end up with a false sense of safety. So really important, make sure that your agreements are drafted in legal English and Chinese according to the Chinese rules and regulations. So look at it as an insurance policy that will also protect you on the Chinese market. And then I would like to highlight marketing and branding. Again, really a key, especially also for those of you who are considering cross-border e-commerce or selling online in China. And here I can only recommend that you always use a China marketing specialist to adapt your storytelling and brand messaging to the Chinese consumers and customers. Don't try to kind of translate or try to adjust your brand messaging from Europe to China. It will rarely work in this market. But you also need to be aware that no matter what, it does take time, effort, and not least money to build and create a stable Chinese customer base in China. And then I will end up with recruitment and employment, which is of course something for those companies who are planning to set up a business in China, an entity. And again, if you're a new company to China, I would definitely recommend that you use a professional and experienced recruiter from the start who understands the local labor market, salary levels, and can ask what I call the right type of Chinese questions. There is nothing called a Chinese labor market. It's very diversified, and really a local understanding is really key. And then when you then do the recruitment and the selection, I've also really emphasized that always let the salary be a function of the job requirements, and do not let the selection be a function of the salary. There are, again, a lot of examples where companies underestimate the labor costs and other costs for hiring and firing people. So they end up maybe identifying the right candidates, but the budget is insufficient, and then they end up picking the second best. And this is, of course, unfortunate, because at the end of the day, the right human resources, recruiting, employing the right people is really the key to get success, to be successful in China and ultimately make a profit on the Chinese market. And then, as a final say, this is basically our team in China, and we also have a representative in Denmark. And as I like to say, when it comes to China and doing business in China, PRC, People's Republic of China, in fact, think at it as more as patience, relations, cash. If you have that in mind, then you actually be ahead of the game. So thank you very much for your attention, and I will now share my screen or end my screen sharing. Here you go.
Wonderful. First of all, thank you so much, Noam. While I get the slides back up here on the screen for the Q&A session, it's a very interesting situation that the World Bank has rating the easiness of doing business in China to be quite difficult, while at the same time we see this GDP growth in China and expecting China to be one of the main, or if not the only major economy to get back to normal now. So that of course shows a very clear need for some of these things that you have gone through today. Before we get into the questions, we have already received a couple and we will try to see if we can answer all of them today. I just want to say that from the EU SME side, actually on our website, it is possible to find a lot of coverage on tax issues, either through the FAQ part on the EU SME website, but also through dedicated reports which have been made as well for non-resident enterprises in China. So that was a little bit about something you covered on tax issues. I also want to say another thing that we have on the EU SME website and the reports on the website is that there's been a lot on how to conduct due diligence on partners in China. And actually, the EU SME Center is receiving a lot of emails on a weekly basis, in fact, from European small and medium-sized enterprises asking if the EU SME Center can check up on Chinese partner companies, if they actually exist, or whether or not it's possible to verify a company job. And our short advice, as you've also touched upon, Noam, is that a lot of these fraud cases could actually have been avoided if it had been researched in a proper way in the beginning of the process. So that's just two comments I would like to add before we get into the Q&A. But now let's get into the Q&A as well. I want to say that here on the screen, which I hope you can all see, there is a QR code. For those of you who have the possibility to do so, please scan the QR code as well and take a few minutes to fill out the feedback survey that we really hope that you would like to help us with, so we can improve these webinars and other activities in the future. Now, Noam, with all of that out of the way, we have about 15 minutes exactly to do the Q&A. So let's get right into it. The first question that we have received is as follows. To what detail shall authorities understand your products or software solutions before approving for FDI or qualifying for tax incentives? I mean, shall they see drawings or detailed descriptions of how machines or software works?
Well, I cannot give you a clear answer, because if you look at the catalog, they are more in general. So you actually have to contact the local authorities to really understand the details of the requirements. Again, I don't know exactly when it comes to software and IP-related foreign direct investment. So as far as I understand, you don't need to basically share your IP rights, definitely not. Of course, this has also been a much debated area, whether you actually need to share your IP rights or being forced to share IP rights in China. And of course, in the past, that has been an issue. but increasingly not so. So if you actually refer to the foreign investment law, it's very clearly stated that this forced transfer of IP is not required. So again, I could get back to you, but it needs to be very specific, and of course it needs to match the actual catalog for your specific product.
Thank you for that, Norm. And then we'll move on to the second question that we have received. And the second question is, let me find it here. The second question is about what the potential penalties are for being late with declaring taxes or other things for the authorities. Could it be penalties in forms of having to pay money, or could the company be blacklisted, company even be dissolved, or even go as far as to have jail time as a penalty?
You almost answered the question there. Yes, the tax bureaus in China basically operate with this classification called A, B, C, D, and M. M refers actually to companies that are newly established, where the parent company actually has to have a classification of either A or B. So as I mentioned, also when it comes to closing down a company, making sure that you paid your taxes on time is really key. Otherwise, they will enforce penalties. There's no rule of thumb what those penalties are. Of course, it really depends on your tax liability, but ultimately you can be blacklisted, and then it can be very difficult, for instance, to conduct business or even close your business in China. So I would say tax compliance is extremely important, because at the end of the day, of course, there's also some personal liabilities at the end if basically you are trying to avoid paying taxes in China.
Thank you for that, Norm, as well. We'll move on to the next question here. And the next question is on the scope of operations. The question reads, are there still restrictions or distinguishments between manufacturing, trading, service companies? For instance, that a manufacturing company cannot also trade items split, say 50-50, or can one company entity do all three operations as long as it is registered for such?
Well, I assume this is relevant if you're a manufacturing company. So as I mentioned in my presentation, in simple terms, companies can be involved in services, trading, and manufacturing. But as a manufacturing company, obviously, you can also be involved in trading because you need some components. Maybe you need to import them, and you actually also need to export those products. What is really the key is what is really the main business. So if your main business is to produce metal pieces, then of course you cannot start trading in furniture. So it actually needs to be really directly related to your business. And yes, in the past, there was this kind of 50-50 that 50% of maybe of your activity level could be trading, and then you will not be a violation of your production license. But I would say you probably need to go a little bit further down. You cannot speculate in actually operating a manufacturing company, but actually a big part of your business is trading. So in this case, it's quite common for manufacturing companies to set up a trading company, and then they can operate that side of the business independently.
I think that was quite clear, and it actually also answers to some extent the next question here, but I'll answer it anyway. It's very related. So that question is, can one company do both wholesale and retail sales if registered for it? For instance, a company selling items through wholesalers, but also direct to consumer online.
Well, there's nothing that would prevent you from, if you have an entity in China, to both sell to wholesalers and then sell directly to retailers. Again, it really depends on the business you are in and the defined business scope. So one does not exclude the other, not at all.
Good. We have the next question here, and that is on the topic of contracts. So the question reads, can a foreign and Chinese business partner agree to use, for instance, EU regulation as a legal frame, or will the Chinese law system not recognize this mutual agreement?
Well, there is nothing that would prevent you from entering an agreement according to any other jurisdiction. Not at all. But the reason why I'm emphasizing that it's probably better to do it according to Chinese law is, of course, that if you have a dispute in China and the agreement you have signed has regulations or things that are against Chinese law, then it doesn't matter what you've agreed on because you can actually not enforce it in China. So to one extent, please just make sure you can have your own terms and conditions, but it's really important that you ensure that you don't have terms and conditions that are actually not enforceable in China. And you also make sure that if there are any gaps, then these are included in the contract. So the key is really to make sure that you can enforce your rights in China. But again, you can agree to do it in English and you can agree to do it according to Hong Kong law. But I think in practice, this can only create problems down the line.
Thank you. And then the next question is, I guess it's not that easy to answer because it differs from sector to sector and from company to company. But a question that was put into us was, what is a monthly average salary level without extras in the area of Shanghai for, let's say, recent graduate commercial or engineers? Has it changed throughout the 10 years? Maybe it's easier to answer that way.
Well, it has definitely changed, but I would say forget about all this statistics, because statistics on salary levels in China and even in Shanghai make no sense whatsoever. Because in China, there's a huge difference between a title and responsibility. So China will often give people manager titles without actually having any managing responsibilities. So it's really also depends on where in China, and in this case in Shanghai, you are. What really matters is demand and supply. So if you have some idea of the ideal candidate who speaks English, have 15 years of experience, some of these people can be more expensive than in most European countries. So I would rather say, in order to answer that question, you actually need to look at the actual job description, the responsibilities, and then you need to basically speak to a professional recruiter, and they will be able to give you a qualified answer, because the gap between people on paper with the same experience, with the same title can actually be manifold. So unfortunately, you cannot really give an exact figure, and there are no really official statistics that can be relied on.
Thank you for sharing those thoughts, Noam. The next question is like this: what are the business advantages of establishing a holding company in Hong Kong, for instance?
Well, I would say the advantages are less than they used to be in the past. Until maybe 10 years ago, setting up a holding company in China that then became the investor into China was quite popular. There was a tax reason, simply because at that time, China and Hong Kong had signed an agreement that basically only applied this 5% withholding tax. So many companies would basically direct their profits via Hong Kong and then home. But as I also mentioned, more and more countries actually have the same requirements and can offer this 5% withholding tax. So I would say from a profit financial point of view, the advantages are much less than they used to be. And this is also because the Chinese authorities are very much focused on money laundering and other high or sensitive areas. So in the past, I would say it was a gray area. The Chinese tax authorities would kind of not look into the detail. But today they are very focused and strict on companies that own a China entity through a holding company. So I would rather say the advantages more relate to a strategic and ownership requirement. So it is still much easier to basically change owners, investors in Hong Kong than having to do it directly in your China entity. So you can actually easier sell your company, you can easier replace investors and get other investors in without it will directly impact your operations in China. But the Chinese authorities is also very much focused on beneficial ownership. So they will need to know who are then the beneficial owners if there are some changes in Hong Kong. So again, there might also be some legal issues. If there are any disputes, then of course, common law in English also applies in Hong Kong. But I would say tax-wise, not so much anymore, but still from a kind of a strategic point of view, there can be some benefits of having a holding company in Hong Kong. But do remember, there's also a cost related to having a holding company. And as I also said, when it comes to profits, you cannot just have a postal address and then think that you will somehow be able to enjoy these lower withholding taxes. So you have to basically approach it completely differently than maybe 10 years ago.
Thank you for those reflections as well. We have just a few questions left and just a few minutes left as well. So let's see if we can get through all of them. That would be perfect. The next question reads, how long could it take to do the capital report, in particular to start paying salaries?
Well, I'm not dealing with payroll and capital reports. Again, I could connect with, I think it's Cater, and then basically check up. So I'm not, unfortunately, able to answer that questions. But again, I have both legal and finance professionals in my team that can answer that question.
Thank you. And to that, I can also just remind that on the EUSME website, there's also the Ask the Expert function. So any of these questions that you may have that may not necessarily relate to the topic that the Norm is explaining about today, please submit the questions to the EUSME Ask the Expert function on the website. Let's jump on to the next question, Norm, that reads, how does foreign exchange control in China affect doing business in China?
Well, as I mentioned, if you comply with for instance, the tax regulations, there are no that prevents you from transferring profits out of China. And the same also goes if you have a normal business, you are selling goods overseas and you are invoicing them in US dollars. Again, as long as it's a normal, transparent transaction, there are actually no limits on the business that you can conduct. There are some limits, for instance, on personal transfer of foreign exchange. I think it's $50,000 per Chinese citizen. And of course, there have been examples or periods where there's been extreme outflow of capital from China to overseas, where the authorities have stepped in and basically closed the door until it's settled, and then they've allowed the exchange to proceed. So again, as long as it's a genuine business with normal transactions that are of course registered through legal invoices, then there are absolutely nothing that will prevent you from doing business in, for instance, US dollars. But obviously, if you're a China entity, the money will then be transferred to your foreign exchange account. And then if you want to use them, they would need to be transferred into RMB. So you can only use RMB in China.
Thank you. And then I just want to say we have 2 questions left. So let's close the Q&A submission now and then just run through the last 2 questions before we let Norm leave. So the next question, Norm, let's click this one. No, sorry, actually we have just one question. The last question is there any limitation or sanction in registering a company providing services in one location in China, but then as a matter of fact, operating in another location in China?
Not per se. If you have set up a company in one part of China, you can conduct as much business anywhere else. The real issue is, of course, the person you employ will, of course, be employed by your company in the city where your company is registered. And the same goes with the taxes that need to be paid. But there's nothing from you to prevent from conducting business elsewhere than the place where you have set up your business. But again, it would make sense to also have some kind of business in the city where you are present, because again, the tax authorities might question what are your intentions. But as such, China is open no matter where you have set up your business or your company.
I think that will be the last question that we go through today. So it's also 6:15 here in Beijing, at least. I know many of you are tuning in from various places and various time zones around Europe and other places. So here at the end, I just want to say thank you to all of you for joining today's webinar on how to get started on doing business in China. A big thank you to you, Noam, co-founder and China business advisor for China Direct Business, for sharing your knowledge with us today. Don't forget to keep an eye out on future EU SME Center activities, either on the website, on LinkedIn, or Twitter, or WeChat. I think that was all of them that I remembered there. Should you have any questions or comments, then be sure to let us know. We hope you can take the time to fill out the survey to help us improve even more for next time. And with that, those will be the final departing words for today. So once again, thank you all for joining, and thank you especially to you, Noam.
Thank you to the EU SME Center and DCCC. Thank you.
Thank you. Then we'll close today's webinar now. So bye-bye, everyone, and thank you for tuning in.